So if you've ever dipped your toes into DeFi, you know exactly what I'm talking about. Earning yield can feel like you're trying to solve a puzzle in the dark. It's complicated, it's a little bit scary, and the rules seem to change every single day. But what if there was a way to just put it all on autopilot? Well, today we are building the ultimate blueprint for doing just that. We're going to figure out how to understand and, more importantly, safely use DeFi yield aggregators. Let's dive in.
So here's our game plan. First, we'll talk about why this is so hard in the first place, the DeFi yield maze. Then we'll introduce your autopilot solution. After that, we're going to pop the hood and see exactly how these things work. Take a look at the major players, and then I'm going to give you a super practical checklist so you can vet these projects for yourself. And finally, we'll get right into security, specifically how to do all of this safely with a hardware wallet.
So let's start with a big question. Why do we even need these tools? Well, it's because trying to earn yield by yourself in DeFi can feel a lot less like investing and a lot more like a stressful full-time job. Honestly, the sheer complexity is a huge barrier for almost everyone. Let's break down the actual pain points of going it alone. First up, gas fees. Remember the 2021 boom? A single transaction on Ethereum could cost you $50. $50! That just eats up all your profit. Then there's the complexity. You're juggling a dozen platforms, trying to make sense of it all. Plus, you have to be watching it 24/7 because the best opportunities are always moving. And underneath all of that is the biggest fear of all, security. One wrong click, one bad smart contract, and poof, your funds can be gone. Forever.
Okay, so that's the problem. It's a real headache. But this is where yield aggregators come into the picture. They are designed from the ground up to be the elegant, automated solution to all those problems we just talked about. This is the autopilot for your crypto portfolio. So what are they exactly? Well, at their heart, yield aggregators are just smart contracts that are constantly hunting for the best returns across the entire DeFi world. You just deposit your crypto into one of their vaults, and their code does all the heavy lifting for you, moving funds around to get the most bang for your buck. It's the ultimate set-it-and-forget-it machine for a super active process.
And the benefits are pretty amazing. First, because everyone's funds are pooled together, those crazy gas costs get shared. They become tiny for any one person. But the real magic, the secret sauce, is auto-compounding. The platform automatically takes your profits and puts them right back to work, earning you even more profit. It's a powerful growth loop. It just simplifies everything down to one deposit and lets you tap into strategies so complex you'd never be able to do them on your own.
Okay, so it sounds great, but how does it actually work? What's really going on inside that engine room to make all this yield happen? Let's take a look.
Well, the yield isn't magic. It comes from three main sources that are already out there in DeFi. Number one, lending. The aggregator can put your funds on a platform like Aave and earn interest from people who borrow it. Number two, trading fees. It can put your funds into a decentralized exchange like Uniswap and earn a slice of every trade. And number three, liquidity mining. This is where other protocols literally give away their own tokens as a reward to attract capital. The aggregator just goes out and collects all three of these for you.
And this visualizes that compounding magic I was just talking about. So you deposit your USDC. The vault puts it to work. It starts earning yield from all those sources: interest, fees, reward tokens. Then, and this is the most important step, it automatically sells those reward tokens for more USDC and immediately puts that new USDC back into the strategy. This loop just runs and runs 24/7, growing your stack without you ever having to lift a finger or pay a single gas fee for all those little steps.
Okay, so we get what they are and how they work. Now let's zoom out a bit and take a look at the bigger picture. Where is all this happening, and who are the key players you need to know about?
Right now, one of the biggest trends in all of crypto is this huge migration away from Ethereum mainnet, that's layer 1, to layer 2 solutions like Arbitrum. And it's not hard to see why. Look at this table. You could pay over $50 for a swap on Ethereum, or you could pay less than a penny on Arbitrum. It's a no-brainer. This makes all these complex strategies actually profitable on L2s. And because there's less total money on them right now, the yields can often be much higher. The frontier of DeFi has, without a doubt, moved to layer 2.
And here are some of the names you're going to see out there. You've got the OG, Yearn Finance. They basically invented this whole category. Then you have multi-chain powerhouses like Beefy Finance, which operate on Arbitrum and a ton of other chains. You also have specialists, right? Convex is laser-focused on one protocol, Curve. And Badger DAO is all about one thing, getting Bitcoin into DeFi. So you see, there's a different flavor for every kind of investor.
And that brings us to what I think is the most critical part of this entire discussion. We've seen the potential, we've seen the upside, but DeFi is still the Wild West, and it is full of risk. So how do you tell the difference between a solid long-term project and something that's going to disappear overnight? Well, here's the mental model you need.
So, what are the actual questions you need to be asking yourself before you deposit a single set? What are the big green flags to look for, and what are the massive red flags you need to run away from?
It all comes down to one word: trust. And in a world where the code is the law, trust isn't built on promises, it's built on security audits. This quote says it all. Audits aren't just about finding bugs, they are a signal. A signal that a project is serious about protecting user funds and building something that lasts. It's the absolute first thing you should check for. No audit, no deposit. Simple as that.
So here it is, your 5-point due diligence checklist. Number 1, audits. Have they been audited by firms people actually respect? Number 2, total value locked, or TVL. How much money have other people already trusted them with? Number 3, performance. Look for something called the price per share of the vault. You want to see that chart going steadily up and to the right. If it's flat or going down, that's a huge red flag. 4, check out the team and the community. And 5, look at the tokenomics. Is the yield real, or is it just smoke and mirrors from inflation? And when we talk about TVL, we are not talking about small numbers. The yield aggregator market had over $4 billion locked in it at the end of 2022. Now, that high TVL isn't just a vanity metric, it's a powerful signal. It's a vote of confidence paid in billions of dollars, and it shows that a protocol is battle-tested and has a lot of skin in the game.
Okay, a really critical warning here. You're going to see projects promising insane returns, thousands of % APR. You have to be extremely skeptical. If it looks too good to be true, it is. Almost every single time, those yields are fake. They're just printing a worthless token out of thin air to pay you, and that token's price is going to crash to zero, leaving you holding the bag. Real sustainable yield comes from real activity, like fees and interest, not from a magic money printer.
Now let's get super practical, especially for those of you who take security seriously. I'm talking to my fellow hardware wallet users out there, the people with a Ledger or a Tangem. How do you actually use these protocols safely and make sure they play nice with your setup? You have to understand this one critical concept: blind signing. It's one of the biggest risks in DeFi. It's when your wallet asks for your approval, but it can't actually tell you what you're approving. You're basically signing a blank check. It's incredibly dangerous. The solution is called clear signing. This is when your hardware wallet screen shows you in plain English exactly what will happen. It'll say, you are sending 100 USDC to Beefy Vault. This lets you verify everything before you approve. It is an absolute game changer for security.
So here are your personal security rules of the road. 1. Check for native hardware wallet support. Does the site work directly with your Ledger or Tangem? 2. Avoid blind signing at all costs. Make sure the dApp supports clear signing. 3. Stick to the battle-tested protocols, the ones like Yearn or Beefy that have been around for years and have multiple audits. 4. Always double-check the contract address on Etherscan to make sure you're not on a phishing site. And finally, number 5, limit your token approvals. Think of it like digital hygiene. Periodically go in and revoke old permissions you've given out.
So when you put it all together, taking away the insane costs, the mind-numbing complexity, and the need to monitor everything 24/7, you realize that yield aggregators do more than just help you earn a return. They make a really powerful piece of this new decentralized economy genuinely accessible to a much wider audience. Which leaves us with a pretty big question, right? Are these the tools that will finally unlock DeFi for the mainstream?